Hey guys, it's David from Bargain Issues here. I am doing my first full analysis completely by recording. Their largest client, to give you some perspective, is Whole Foods. It's about a third of their business. They're the primary distributor for Whole Foods. What is interesting about United Natural Foods is their share price recently took a 25% dive. Even more startling is that happened in one day. Now, the obvious question that is raised would be, what the heck happened? Why did the business go down so far? I'll throw up the technical chart for United Natural Foods, and then looking at the technical chart again, you can see that last red candlestick right at the end that's separated from all the others. That indicates the very large sudden drop in share price. But we were already on a downward trend before that. Looks like that started back in the end of July. And taking a look at the fundamental chart, if you look at the top two bars, that's share price and equity per share, we can see that the share price is $14.88 and equity per share is $36.05. That is insane. The reason it's insane is because equity, it should, in a rational world, never be the case that a profitable business is trading for less than its total equity. Okay, if United Natural Foods got liquidated tomorrow, investors would nearly double their money. They would nearly triple their money. Think about that. The share price is a little more than a third of total equity. I mean, that's pricing the business like it's gonna collapse any day here, and it's very financially strong. You look at the interest expense on the income statement, it is a tiny fraction of operating income. The reason that is significant is because it indicates that United Natural Foods can pay off all of its current debt. Or I should say, it can afford the interest payments on all of its debt. It is also important to note that when Amazon acquired Whole Foods, in the time that Amazon has taken over, net sales to Whole Foods has gone up by 20%. Revenue in 2009 was $3.4 billion. Total revenue in 2018 was $10 billion. You can see how much this business has grown in the last 10 years. You can see how cheaply it's trading right now on the fundamental chart. And what's also really interesting is they just acquired Super Value, another grocery distributor. And this quarter was the first 10Q form that it's come out since they closed the super value deal. Now, when there's an acquisition, there can be non-reoccurring expenses that occur with acquisitions. I see this all the time. It doesn't faze me at all. And there were some non-reoccurring expenses present with this acquisition that caused a negative EPS. Oh no, for one quarter. And the business management also said they expect they expect, let me check my notes, about $59 million in additional kind of one-time expenses related to the acquisition throughout 2019. And the silver lining here is they have the ability to pay this off. They didn't go out and buy something they couldn't afford. I think United Natural Foods made a really good move here. They're expanding their footprint in the market, their client base. This is just a solid business all around, and it is trading really low right now. And you know, you look at the debt to equity ratio, and it went from like 0.61 to like 2.4. And that might also be the reason for the sell-off. But when you see a business that has the ability to pay the debt off with ease, you know, there's an investor presentation, and I'll link in the video description to where I'm getting the financial data from on Morningstar. I'll link to some of the SEC filings and the investor presentation put out by United Natural. So there's no question of their ability to pay. And it's really just baffling why this business would go so low right now. You know, there's one bad quarter because of some non-recurring expenses. Expenses for the next year are going to be a little bit higher. Super Value has some retail stores that they own. Well, United Natural Foods doesn't operate actual physical grocery stores. They're a grocery distributor. So they're going to be divesting those assets. They don't intend to continue operating those grocery stores. They're going to sell them off, and they expect to basically have to take a loss when they do that. But, you know, when annual operating income has historically, even before the merger, annual operating income for United Natural Foods has been around $240 million a year. So you saying, okay, you know, they took like $68 million in non-reoccurring expenses right off the bat. That was this quarter. That's why there was the negative EPS, and then stretched across the next 4 quarters is an additional $50 million in expenses that involve kind of, you know, integrating the two businesses' supply chains and divesting some of those assets that aren't needed anymore. The business is still fine. And in 2020, boom, they're right back at it again, even bigger, even better, with all the merger expenses behind them. You know, I've been a shareholder in other businesses where the timeline for, I guess, all the synergies to be realized is sometimes like 3 or 4 or 5 years. But this is like, there were 2 big blocks of expenses that were going to crop up, and one of them already came and passed, and it was no big deal. and then the other one is spread out across next year. And it's so small that it doesn't even put the business into the red. Yeah. And the growth that they're achieving, even though their expenses are kind of higher, like their profit margin might be a little bit lower in 2019 than what it'll be in years going forward, but their total like net income will very likely be higher in 2019 because of this acquisition. And as they pay this debt off, and I've been kind of building up to this point for a while, equity is $36 per share, and it's trading at $14.88 per share right now. As they pay this debt off, equity per share is going to go even higher. I mean, an investor could triple their money in 3 or 4 years, potentially. I don't see the boogeyman here. I mean, you look at the cash flow statement. You know, operating cash flow is stable and has grown drastically in the last decade. I mean, you just see year after year after year of them doing well. You see that they're sticking to their strategy. And, you know, there is something called naive extrapolation, which gets people in trouble all the time investing in stocks. In basketball, they call it the hot hand fallacy, you know. This isn't the case with United Natural Foods. I mean, I don't think this is a case of naive extrapolation where I'm just looking at their past record and saying, oh, you know, they're going to keep on doing what they're doing just because. It's like, no, you look at their past record, their strategy has been effective, they've grown immensely over the last decade, and nothing's really changed. The marketplace hasn't changed. You know, they make a lot of their sales domestic in the United States, so this whole tariff thing with China really doesn't matter, and it's not like the Chinese are buying organic food from America anyway. At least I don't think they are. But 30% of their sales are through Whole Foods. That's their largest client, and that's all domestic United States. So what's changed? And they've even shown an intelligent commitment to their successful long-term strategy. You know, they bought Super Value, and instead of saying, hey, let's give it a shot, let's start trying to operate some grocery stores, let's compete in a market we've never competed in before and don't know what we're doing. No, they didn't do any of that. They're selling off the assets, and they're taking a one-time loss, and they're moving on, and they're going to continue to be the great grocery distributors they've been for the last decade. You know, they've been winning, and I don't see why that would suddenly change. And, you know, this is also when the concept of a margin of safety comes into play, because I'm not saying, oh, I think, you know, United Natural Foods is going to, you know, explode and go crazy. I'm saying there's the potential for equity per share to rise, but the share price is already so far below equity per share that, you know, they could fall flat on their face and destroy a bunch of shareholder equity and have equity per share go down to 26, and that would still be above where we're at right now, to fall below share price, right? I don't see equity per share falling below share price. I see share price coming up to exceed equity per share, as is rational. This is a business that's generating cash flows for shareholders. They're increasing equity for shareholders, you know, and I honestly, I'm really at a loss as for why a mispricing this bad would occur. I mean, this is extremely profitable, a potentially profitable opportunity, and it does not make any sense to me why the market's priced it like this at all. I always think of when I'm buying stocks that I'm buying a piece of ownership in an actual business. There is nothing wrong with this actual business. I mean, you know, and this, like I said before, this isn't a get-rich-quick scheme. You're not going to be able to buy this stock and turn around tomorrow and sell it for more money. It might take years for the market to realize it's messed up on this one. Warren Buffett, I quote him on this all the time, he said once it takes him 3 years for him to know whether or not he made a good investment. That's a long-term horizon. And this could be a long-term horizon, but right now, whew, man, it is insane how cheap this stock is. Let me kind of, before I sign off here, let me just summarize. United Natural Foods, big acquisition of Super Value, total revenue is going to go up. They've had some non-reoccurring expenses related to this acquisition that are going to stretch into 2019. Whoop-de-freaking-do. It's trading for way less than its market cap is substantially less than shareholder equity right now. And as they pay off the debt they accrued from this acquisition, equity per share is going to go even higher, and the share price is either going to have to rise, or this crazy disparity between shareholders' equity and market cap is just going to get bigger and bigger and bigger, which just makes it more and more attractive to buy. You can only have an irrational reaction to a stock for so long before it becomes such a good deal. People wake up and go, hey, I want to buy that. So yeah, my notes will be in the description. I'll put some links to some of the documents I've been talking about. Feel free to leave a comment, subscribe, message me if you have any questions at all. Please review the disclaimer on our website. Again, this is David from bargainissues.org. That's bargainissues.org. And yeah, we got a Facebook page, a YouTube channel, a phone number. I don't ever call it, so I don't remember it. It's on my business card. It's on my website. Go take a look at the website. You can get the phone number. You can call me up, ask me a question if you have anything, you want to ask me anything about what I've said. I've got a P.O. box if you're like really old school and you want to write me a letter. That would be really cool if someone wrote me a letter. But you can do that too, bargainissues.org.